So for those joining in for the first time, we did an introductory session, I think a couple of weeks back on just giving an overview on the part two businesses for enrolled agent. So today we'll be starting off with our unit one, which is business entities. Um, in this, we'll be covering the basics of business entities, including their characteristics and tax implications. And also we'll be looking at some of the specifics of different types of entities and what their tax treatments are. So we'll be going over those topics. And at the end of the session, we'll also have a Q&A so that any open questions can be answered. So that'll be format of this session. And then when we regroup tomorrow, what I would want from each one of you is to go back and spend about 30 minutes or so reading the textbook given by Fast Forward Academy on this unit one, so that when we come back tomorrow, we can, you know, look at the portal and go through some of the multiple choice questions together as a group. And I think we'll spend the first 10 minutes tomorrow as a revision before we move on to the next chapter. All right. Did that. So these are the topics we'll be covering today. Business entity overview, like I mentioned, we'll be looking at different types of entities, what they mean from a US tax perspective. It's quite similar, but we'll be looking at those specifically. We'll also be looking at what is the meaning of employees given by the Internal Revenue Service, the IRS, employees per US tax. We'll be looking at what the withholding and reporting requirements are for these employees, some of the informational returns, when does it need to be filed, what are the due dates for each of these informational returns. We'll also be talking about the different accounting periods and methods available for a taxpayer in the US. And then lastly, we'll be closing off with a Q&A. All right, let me just look at what's in the chat box before we move on. Right. I don't think there are any open questions, so we can get started. Okay. So record keeping, the first topic is record keeping. This is no different than what is expected out of a business in India. So, taxpayers must maintain accurate records. Obviously, when they're claiming certain deductions on the tax returns, there can be tax authorities that can come back and ask you to substantiate how did you claim those deductions. You need to have receipts, you need to have any canceled checks, bills that can describe the nature and amount of the expense. So for example, if you owned a business and you purchased a laptop, say about for $1,000, you must also have the receipt showing the purchase date, the store where you purchased from. If you purchase it online, you can obviously download the tax invoice, and it also needs to have the amount paid, including the tax amount. Because if you're claiming it for business purposes, this is definitely required. From an IRS standpoint, it can happen so that when you file tax returns, there can be audits that are conducted. Um, so you need to have these records maintained for a certain number of years. And we'll be looking at, what those period of limitations are from a US tax standpoint. But it's no different than what we expect from a business in India. So it's as simple as, just making sure you have accurate records to substantiate your deductions that are claimed on the tax return. From a period of limitation standpoint, now the IRS, the Internal Revenue Service, which is the highest tax authority in the United States, has provided specific time frames where it can go back and audit your tax returns, or for taxpayers to amend their tax returns. So in certain cases, what might happen is you might have not reported income accurately, or you might have filed a fraudulent return, right? You might get away during that year thinking that you fooled the IRS, but there's certain number of period that IRS can go back and audit your tax return. and they can, levy heavy penalties. They can seize your personal property. So all of that can happen. And there are specific periods for each of the different situations that we'll be looking at, and which is highlighted on the slide deck. Um, so if you had additional tax that is owed, right, and none of the below criteria is met, the IRS has set a time frame of 3 years that it can go back and audit your tax returns. So in the current year, we will be filing returns for tax year 23, right? So any year before that, right, tax year 22, tax year 21, and tax year 2020, the IRS can go back and audit your tax returns. So that is the first scenario. If you fall under the second scenario where you do not report income, and if it is more than 25% of gross income, right? Say you underreported income by 25%, then the IRS can go back up to 6 years. In cases where you have filed a fraudulent return, or if you have not filed a return at all, obviously there's no limit on when the IRS can go back. It can be up to 20 years. It can go back and say that you needed to file a return in 2000, 2001, right? So there's no limit to that. In cases where you're claiming a credit or refund after filing the return, right, there might be instances where you realize that you probably could have claimed a certain deduction and taken the benefit on your tax return. Obviously, you will go back and amend your return. So in cases like those, the IRS can go back for a later of 3 years from when the return was filed, or 2 years after the tax was paid, whichever was earlier, right? So sorry, whichever is later. So that is another scenario to remember. And then the last scenario is where you claim a loss for worthless securities, right? Certain securities might be worthless at the end of the tax year, and you might be just claiming a big loss on your tax return. So the IRS can go back and audit to ensure that it is accurate. Those are not just, losses that are claim just to get the benefit, and it is you know an organic loss that was incurred as part of the security transaction. So the IRS can go back up to 7 years in those cases. So again, the period of limitations can differ in different scenarios. You need to remember these years and what the period is specifically, because you will have multiple choice questions on these scenarios. So again, if you just owe additional tax, it is 3 years. If you have reported or underreported your income by more than 25%, it's 6 years. If you filed a fraudulent return, or if you have not filed a return, there's no limit. In cases where you're filing to just claim a credit or refund after you filed your original tax return, then it is later of 3 years when the return was filed, or 2 years after the tax was paid. And then last one, obviously, if you're claiming a loss from worthless securities, it's 7 years. Okay, I see there's a question on the second last point. So claim for credit or refund after filing the return, right? So imagine you filed a return on, let's look at it on the Excel sheet. Is everyone able to see my Excel screen?
Yes.
Yes.
Okay, great. So say you filed the return on March 31st, 2023.
Uh, Hi, sir. Sorry for interrupting. Can you please zoom in a bit?
Sure, let me zoom in. Is this better?
Thanks. Yeah.
Okay. So say you filed the return for tax year 22 last year on March 31st, 2023. You paid the tax after a month for whatever reason. It could be you paid it on April 30th, 2023. So the statute of limitations says that it applies later of 3 years from when the return was filed, which would be March 31st, 2026, or 2 years from when the tax was paid, right? 2 years from April 30th would be April 30th, 2025. So in this case, what would be the statute of limitations based on what we went through? Can anyone answer that?
2026, 31st of March.
Yes.
Later of
Exactly.
the
Right. So in this case, the IRS has up to March 31st, 2026. They have until that time frame when they can go back and audit your tax year 22 return. Now let's look at another example. So again, we are filing tax year 2022 return. Say, you file the return on March 31st, 2023 again. But in this case, you probably paid tax maybe April of this year. Let's assume that. Probably you do not have enough cash, or for whatever instance, you just paid the tax after a year, inclusive of any penalties that was levied. So you paid on April 30th, 2024. So in this case, it would be 3 years from when the return was filed, which will still be March 31st, 2026, or 2 years from when the tax was paid. So now this would be April 30th, 2026. So in this case, what would be the statute of limitations?
April 30th, 26.
April
April
30th.
30th.
Right. So in this case, it would be April 30th, 2026. So
Yes.
again, you just have to remember that it is later of 3 years from when the return was filed, or 2 years from when the tax was paid. So any date that is later, that is the statute of limitations. Yes. Is the point clear? Okay.
Yes.
All right. So let's go back to our slide deck. Yes. Did someone have a question?
Sorry, this side Prabhakar. So I just wanted to let you know that today is my first day. So are we on the first day only? Training is going on for the first day only?
Yes, Prabhakar. So this is the first class. We did have a orientation session that was a broad overview, but this is the first unit that we are covering today.
Okay.
Do we have to write all the things which are there on the dashboard?
Sorry, I don't know who's speaking, but your voice is not audible. Could you repeat your question?
Is it my name is Pammi. I want to ask that whether we should have to write all the things what is there in on the dashboard.
No, I wouldn't recommend writing any notes at this point. What I would recommend is you guys participate actively by asking any questions, providing inputs in the chat box. This slide deck will also be circulated. I will make sure that, it's sent to you guys or uploaded on the Simandhar dashboard. So you do not really have to write any notes.
Thank you for the same. I was thinking on the same thing. If it is available for the site, everyone can access at least.
Yeah. And I've made sure that these notes are very concise. Obviously, you have your entire textbook, but these notes will likely be helpful as a last minute revision. So I'll make sure that this is uploaded in the portal.
Yeah.
Okay. If there are no other questions on the topics that we covered, I think the remaining questions can be parked at the end. Just want to make sure we don't interrupt the class. But if there are any questions on the topics covered so far, let me know.
Yeah, hi Gaurav, Digvijay this side.
Yeah, go ahead.
The last point mentioned in the previous slide, worthless securities. Could you throw some light on worthless securities, please?
Yeah, so it could happen, when say in our stock market example, right? You might buy a stock and you might hold it for a certain period, say 5-10 years, and you might have a target that you want to achieve for that stock. But in certain cases, the fundamentals of the stock changes. Obviously, the company goes through transition over a long period, and we might realize like instances for Paytm, right? Someone would have bought Paytm stock during its IPO, but now they might realize with all the RBI issues that is going on that it's worthless. So they might recognize loss on that security. Obviously, during IPO, it was at a very high price when compared to what the stock price is now. So when you realize that loss on your tax return, right, you would be claiming a loss from that worthless security, and that can be very huge losses that you're claiming, right? It obviously brings down your tax liability. So in those cases, the IRS will have a close eye and close watch, and they can go back up to 7 years to audit your tax return, asking you to amend it, whatever may be the case. If you're just claiming the loss without any substantial reason, then that can be flagged by the IRS. Does it
Okay.
answer your question?
Yeah, absolutely. Thank you so much, Gaurav.
No problem.
Still we can claim, right? I mean,
Yeah, if the transaction is genuine and you have a substantial reason that can be proved, obviously there's no reason why the IRS would stop it. We have seen certain cases where the losses are just claimed without the definition of worthless securities as provided by IRS. So in only those cases, the IRS would want to make sure that you'll have to amend your tax return and pay back any tax liability that will be levied.
So in other words, the IRS may have the list of worthless securities, or directly we can go ahead and file. I mean,
No,
since
IRS will not be issuing list of worthless securities. Obviously, if you look at the Internal Revenue Code, um, there will be a definition of worthless security. So as long as it's meeting the criteria defined in the Internal Revenue Code, you're good. But if it does not meet the criteria, then obviously that is something the IRS will look deeper. Does that answer your question, Praveen?
yes, yes.
Okay, great. All right. So moving on, we are looking at different types of entities. Obviously, we all are aware about sole proprietorship. Any small unit shop, small petty shop that you start owned by a single individual, that's a sole proprietorship. You file Form 1040 with the IRS as a filing requirement, and any income that's generated as part of your business is reported on Schedule C of your Form 1040. So that's covered in your individual taxation, which is part 1 of the EA. So I didn't really want to highlight that, but we'll be looking at the different entities that is covered under this section. So the first one is partnerships. So now partnership is a similar definition from a US tax perspective. Um, it is an entity that is formed by at least 2 partners. Now there's no maximum limit on how many partners can be included in a partnership, but the minimum requirement is that there should be at least 2 partners that are forming the partnership, obviously for an economic benefit. The tax return that a partnership files with the IRS, as we covered in the last session, is Form 1065. And the document that is issued to each of the partners, reporting their income, losses, deductions for the year, is called a Schedule K1. We'll also be looking at this when we talk about partnerships in detail in the later sessions, but just wanted to highlight that Form 1065 is the tax return that's filed by the filed by the partnership with the IRS, and Schedule K1 is issued to the partners. Now, what type of entities can be included in a partnership, right? There can be individuals, there can be corporations, there can be trusts, there can be estates. There can also be other partnerships that are investing in a partnership. We usually call this as fund of funds. So you see partnerships investing in other partnerships, and these type of structures are usually called fund of funds in the US tax world. So there's no limit to what entity types can be included in a partnership. We've also seen government organizations investing in partnership. We have seen educational institutions investing in partnerships. So any entity type can be included in a partnership from a US tax perspective. When we talk about S corporation, now S here stands for a small corporation, right? So S corporation usually file Form 1120S with the IRS. It is a hybrid structure, I would say, when compared to, C Corp and partnership. It has features of partnership while also having and retaining some features of a corporation, right? And that's why it's called a small corporation or S Corp. It has 100 shareholder limit. Now, this is the maximum limit on how many members can be included in an S Corp. And if you are making the election to be filing as an S Corp, it has to be done 2.5 months from the beginning of the tax year, right? So for tax year 23, right, you have to make the election, or for tax year 24 for that matter, you had to make the election on March 15th, 2024, right? That was 2.5 months from when we started, that is January 1st. So that's the time frame when you make the election. One specific thing about S corporation is that um, only individuals or real persons can be part of this 100 shareholder limit. You can't really have corporations, you can't have partnerships, you can't have tax exempt organizations as part of these shareholders. From a partnership perspective, you see that all of these entity types can be partners, but for an S corporation, only real individuals or real persons can be a shareholder in an S corp. So that's one major difference between an S corp and a partnership. Um, Shareholders also receive a K1. So this is similar to partnership, that an S corporation would be issuing each shareholder a K1 form, which will report their income and deductions for the tax year. So that's very similar to a partnership. And again, just wanted to highlight that the S election has to be made 2.5 months from the beginning of the tax year. Now, talking about C corporations, these are regular corporations that we also see incorporated in India or the United States. C corporations are very regular corporations. They're taxed at the entity level, right? When we spoke about partnership S corporation, you need to understand that both of these returns that they are filing, Form 1065 and Form 1120S, is just an informational return, right? They're not really paying tax at the entity level. Partnership does not pay tax. S corporation does not pay tax, right? Now the question arises, who actually pays the tax? It is taxed at the partner level or the shareholder level. So both the partnership and S corp do not pay taxes, but a C corp pays tax at 21% rate on the income that it generates for the tax year. So that's one big difference between a C corp when compared to an S corp or a partnership. It is also double tax for a C corporation, right? C corporation would first pay tax on the income it generates for the tax year, and then when it distributes dividends to the shareholders, they would also be taxed on the distributions or on the dividends that they receive as income, right? So it is taxed twice. That is why it's called a double taxed entity. So just to give you guys an example, if a C corp earns say about 500,000 in profit, let's look at that in Excel. So say for tax year 23, the C corp generated taxable income of 500,000, and we said the tax rate is 21%, right? So what would be the tax liability for the C corporation? It would be 500,000 into 21%. So this is the first tax that the C corp would pay at 21% rate, 105,000. Now, when dividends are distributed, say the dividends distributed out of this 500,000 was about 20%. So out of this 500,000, 20% was distributed to all of the shareholders, right? And assuming all of the shareholders were individuals, right? And they had about 30% tax bracket. So again, the individuals would have to pay tax on this dividends at 30% rate, which would be 30,000. So you see the tax is paid twice on the same income. So that is why it's said to be double taxed for a C corporation. Is this example clear, or do you guys want some more explanation here?
Hello, Gaurav.
Okay.
Hello. Yeah.
Yes, go ahead.
Can you go to the Excel once?
Yep.
So herein is dividends have been paid out, and we have individuals which are claim just paying the tax once it is into the corporation part and another into the on their own level, right? So is
Yes.
there anything just like if they can claim as a kind of credit or something like that in their return for this double taxation just in order to avoid?
No, unfortunately, they cannot. Because just because the C corp is taxed differently at its entity, while the
Mhm.
individuals will be paying tax at their own level. So none of this credit can be claimed at the individual level. So all of this 105,000 goes to the IRS, and then 30,000 goes to the IRS. That is why there's no credit that can be claimed by any of the individuals here.
Because there just 100,000 has already been populated with the 21% of a tax liability.
Yeah, I
And
mean,
then again,
unfortunately, that's the scenario for a C corporation, right? That
yeah,
they do have to pay tax twice, right? Once when they generate the income, and the other time when they distribute the dividends. So there's no way out to get this taxation, but this is how the entity is set up in the United States.
right. I also had one more question that just in the case of partnership, sometimes we also see there are some kind DREs, disregarded entities
Mhm.
involved. Just can you just put some light on that thing?
Yes, we'll be talking about disregarded entity when we talk about LLC, but yeah, I'll
Okay,
cover about that
fine.
as
Yep, thank you.
well. All right. Um,
So
so
I have one
going,
question. So if
yeah.
partnership and yes corp is earning more income than the C corp, in that cases also partnership and S corp will not be paying any tax, zero tax.
Yes, so the partnership and S Corp just file informational returns with the IRS, Form 1065 and 1120S, and they do not really pay tax at the entity level. The people that will be taxed are the partners and shareholders. So when the partnership generates say about the similar income, 500,000, and it has five partners who get 20% each, so each of the individuals or each of the entities that are getting this Schedule K1 will pay tax at its level based on, whatever the instruction says. So the partnership and S corp do not really pay tax, irrespective of, the threshold of income they generate.
Okay.
Yep.
Hello.
Yeah, go ahead, Manjari.
Yeah. I have a question. Then what is the fun in incorporating or setting up a C corporation? Because whatever is the income for passive entities, S corporation and partnership will have to pay the tax only on the 1040 when they report their K1s. But C corporation is double time taxed. So why do people prefer this kind of corporations?
Yeah, I think that's a good question. If I was a business owner, obviously I would think twice before incorporating an EC corporation. Now, what happens in cases of partnership, right, um, is that you might have different kinds of partnerships. You might have general partnership where the liability is not just limited to the investments that you have made in the partnership. It can also be on the personal property that you own or the personal assets that you own if the partnership fails, right? That is one disadvantage of what I see from a legal standpoint. The other disadvantage is that the investment that a partnership or an S corp can raise is very limited, right? You just have 100 shareholder limit for an S corp, and it also depends on the partner's capacity on how much they can contribute as capital, right? When it comes to C corporation, these are incorporated entities that are usually listed on the stock exchange or aspiring to be listed on the stock exchange, right? So they would raise money as part of shares. We've all studied about how money is raised in IPOs or when the companies get listed on a different exchange as well. So they can raise money from the public in different forms. And obviously, the size is much larger when compared to partnership and S corp, and obviously generates larger income based on the different business activities they can conduct. So it's more of an economic standpoint. They don't really look at it from a tax standpoint, right? The more income you generate, the more tax you have to pay. But that's the cost that they incur as part of doing business.
Understood.
And
Thanks.
so one more doubt, sir. Actually, I'm Kameshwar, so I have one more doubt.
Mhm.
So in that C corporation, so only people from other nationalities can also invest. Some sort of provision is like that. Like in S corporation, only local, like natives, and C corporations, they other nationality people can also invest.
Yes,
Some
both in C corp, right? Think about it as you investing in any of the US companies. You can obviously go ahead and invest in, say, Google. You can invest in Apple. You can invest in Microsoft, right? So you are actually a shareholder in this C corporation. It's obviously incorporated and listed on New York Stock Exchange or whatever stock exchange they may be listed on. So there's no limit on which nationalities. It's not limited to United States. And that's the same scenario with S corporation. The thing that I was mentioning for an S corporation is that they have to be real person or an individual that can invest. There's no limit on which nationality is investing. It's just not limited to the boundaries of US.
Thank you.
Could you please elaborate what is asset group under C corp?
Yeah. So an affiliate group, right? We were talking about different characteristics for each of these. So affiliate group is when 80% or more is owned by the corporate, by a shareholder. So let me explain that with an example. Give me 1 second. Let me switch back. And again, just let's keep the questions limited to enrolled agent or US tax. I know there can be different questions coming up as to why a person would want to set up a C corp against an S corp, a partnership. All of that is from a financial standpoint. We don't really want to get into those because focusing it on only from a US tax perspective will help you narrow down concepts. So yeah. So again, affiliate group is when 80% or more of the corporation is controlled by a single shareholder, right? Or through common ownership. It could be indirectly or directly. So these affiliate groups tend to file a combined or a consolidated return at the federal level. So say suppose you had three corporations, right? Um, so the C corp had say three shareholders, and two of these shareholders owned 80%, right? And these were again C corps, and probably another shareholder was an individual. So this was a C corp and this was an individual. And this individual owned 20% of the entire C corp, right? So now what happens is, since these two C corporations, which are shareholders in the major corporation, has 80% control, they are part of the affiliate group, right? So this entity and then these two shareholders can combinedly file a single return when they um, file a tax return with the IRS. And obviously they have other economic benefits in terms of claiming deductions consolidated. Some of these corporations might be claiming huge losses, so it might benefit when they file a combined return. So that's probably an affiliate group. And obviously from a financial standpoint, there are different scenarios. From an tax standpoint, we'll be looking at it in detail when we go to corporations, that what is the impact when you file a combined return as opposed to a single return. Does that answer your question?
Yes.
Okay, sir. So you said that if we want one more example or more example for C Corp, so could you please give us one more example for C Corp?
Um, when you say C Corp example, do you mean about double taxation?
Yes, the same, sir. You just told on. I mean, show us on the Excel, so the same.
Yeah, I could do that. So again, we can take different numbers, but again, it stays the same, right? So if you generated, say, about 100,000 of income, right? Your tax rate was about 21%. It is about 21% for a C Corp. It pays a flat tax on 21,000. Now, for say tax year 23, the C Corp also distributed 30,000 out of this 100,000 as dividends. Then the individuals or the actual shareholders will have to pay tax on this dividends, right? So if you're just expanding on the example that we spoke about, now we have one individual or one shareholder who's an individual, which has 20% rate, right? So this individual will pay tax at say about, it's obviously a graduated tax, but I would just consider for this example as 30% tax. So out of this 30,000, he owns 20% dividend. So he would be receiving 20% of this 30,000 and then paying tax at 30%. So that would be the individual tax liability. Then you would also have a corporate tax liability because, you know, these two shareholders that we spoke about, right, who own 80% of the C Corp would again be paying tax. So the 30,000 that they receive as income times your ownership percentage multiplied by the tax rate, which is 21%, would again be paid to the IRS. So you see the 100,000 income is taxed once at the C Corp level, which is at 21%. And then it's again taxed on the dividends that is distributed. And the tax rate will obviously depend on which entities hold this share of the C Corp. It can be individuals, it can be corporate, it could be, another organization. So the same income is taxed twice when the C Corp files the tax return at its entity level, and the other when it distributes the dividend. Does that answer your question, Ashutosh?
Yes, sir.
Okay, great. All right, so yeah, go ahead.
Yeah, so dividend will also be taxed at 21% while in the respect of the C Corps, C corporate partners.
So I'm just giving a very high level example. Obviously, we will have dividend received deduction, which is called DRD. When we talk about it in detail in the latest session about corporations, we'll elaborate on that. But just for this example, think about it as double taxation. Don't really get into the details of whether the corporate will pay 21% rate because there's obviously going to be this concept about DRD. So we'll talk about it in detail when we get to corporations.
Also, definitely. And in partnership and S Corps, the individuals will be paying the tax.
Sorry, can you repeat the question?
In partnership and S Corps, the partners will be paying the tax, or is it like the C Corp?
Yeah, the partners and the shareholders will be paying tax at their level, depending on what entity types they are, right? If we had individuals in a partnership, say all of the partners were individuals, they will be paying tax on Form 1040, right? Based on whatever the slab they fall under. If it was another partnership, then it never get taxed, right? The partnership, if it has all the partners as another partnership, then they don't pay tax and it flows up. The income flows up. That's why it's also called as a pass-through entity or a flow-through entity because the income is flowed up until it reaches the ultimate individual. Yeah.
Thank you.
No problem.
Hello. Hello, sir.
Yeah, Shobran, go ahead.
As a selection process as corporation, can you explain once more again? S
Shubham, your
corporation.
voice is breaking. Do you mind repeating the question or
Okay.
dropping it in the chat box?
Okay. S corporation as you election process. Can you repeat once again?
Yeah,
Am I
so
audible?
yeah, so a corporation, when it elects to be an S corporation, right, a Form 1120, or if it wants to be an S corporation, then the election has to be made within 2.5 months from the beginning of the tax year. So if your tax year beginning was January 1st, 2024, then 2.5 months from that would be March 15th, 2024. And within that date, you will have to make the S Corp election. So you just have to remember the
Uh,
date, because that can be tested on, the exam, as to they could give you a tax year beginning. They could say that, this entity wants to file as an S Corp. What is the due date by which it should be elected with the IRS to file as an S Corp?
this is for only first year,
Sorry?
which we are which we are incorporating as
Yes,
corporation.
it's just a one-time election, and then you continue to file an S Corp.
Gaurav, as I'm Shivani, good evening. As many of them already requested in the chat box, can all the Q&As happen at the end of the session? Might be there are chances that as you continue the flow, the doubts will be solved in between.
Yeah, sure. I think we can do that. I think it would benefit the entire class that, we don't interrupt the flow. And
Yeah,
then we can take all the Q&As at the end.
exactly, Gaurav, because everyone can just put their query in the chat box and later on we can just go with the questions, I would say.
It
Yeah,
might be the
100%.
queries can also be solved while just listening to the class.
Agreed. All right, so let's not interrupt the class. And at the end of the session, we'll definitely have a block to address all the queries in the chat box, or you could also ask the questions live.
Thank you so much for that.
Yeah.
Thank you. All right, so continuing on, we spoke about partnership, we spoke about S Corp, we spoke about C Corp. It's important to remember what tax returns are filed by each of these entities. And then if we move on, we are talking about limited liability company, or LLC. Now, an LLC by default is a partnership. They can also make a check the box election on Form 8832 to file as a corporation, right? So an LLC can file as a partnership or a corporation. By default, they are, from a tax standpoint, they are a partnership. Now, within a partnership, they can be two things. They can be a single member LLC, which is disregarded for tax purposes. That is, it is owned by one person, 100% owned by one person. So it is disregarded for tax purposes. So that it's also called a single member LLC. Or it can be a multi-member LLC. Multi-member LLC is basically owned by two or more individuals. So in that case, it would be like a regular partnership. Again, Form 8832 is filed by the LLC to elect to be treated as a corporation. Qualified joint ventures is again similar to a partnership. The only difference is that married couple who want to file joint return can elect to be treated as a qualified joint venture, in case they're doing business, they're actively engaged in doing that business and want to reap advantages of filing, from a business standpoint based on the income they generate. Because when you talk about Form 1040, when you file a Schedule C within the 1040, you obviously can claim certain business expenses. So each of these individuals in the married couple would be claiming certain expenses at their own level. So it has the advantages of a partnership, but only limited to a married couple. All right, so moving on, we'll be looking at what are the different definition of employees from a US tax standpoint. Now, this is very important from a withholding standpoint and reporting standpoint, because the IRS has similar concept in terms of withholding, like how we have TDS, tax deducted at source from each of our salaries, that happens every month. Or you also see TDS deducted by the bank, right? So all of the concepts are similar in the US, and you have withholding requirements in terms of Social Security, Medicare, um, which is also called FUTA, FICA. So all of these taxes get deducted based on, the employee definition. So looking at the first one, which is basically statutory non-employee. So these workers are treated as independent contractors for tax purposes. Examples of these could be direct sellers or real estate agents. So if you are a real estate agent, or if you're selling certain product directly from another supplier, then you would fall under the definition of statutory non-employee. They only pay self-employment tax, but are not considered employees as such, right? So self-employment tax can be similarly treated to a sole proprietorship. That is, you're generating income, you're filing a Schedule SE with, Form 1040, and this is just your income that you're claiming. It is not a salaried income, and you don't really have to pay, self-employment tax. You don't have to pay withholding. So the agent or the real estate company that you're working for will really not withhold any taxes before they remit you your payment. Talking about statutory employee, now, as opposed to a statutory non-employee, a statutory employee would be subject to Social Security and Medicare taxes, but they're not subject to federal income tax, right? That is one major difference between a statutory non-employee and an employee. So they're subject to Social Security and Medicare taxes, but not federal income taxes, unless backup withholding applies, right? So examples of statutory non-employee could be full-time agents. Um, uh, these could be insurance agents working for a certain life insurance company. Obviously, we have a popular example of LIC, where we see a lot of agents who are working full-time selling, these LIC policies. In cases of those, they are considered to be a statutory employee, and they will be subject to Social Security and Medicare taxes at a certain rate that we'll be covering, but they will not be subject to federal income tax withholding. Talking about common law employees, now these are defined by certain characteristics. These are regular employees. You can think of it as working in a corporate firm and be treated as a common law employee. Obviously, you're working full time for that company. You are in that full time job. You cannot take up another job. So your services are completely controlled by that organization. So in that case, you will be defined as a common law employee. There are three different characteristics on which, this is defined in the Internal Revenue Code. One is your behavioral control. So all of the behavior within the organization, if it is controlled by a certain employer, then you would be defined as a common law employee. If also you have all of your financial control, right? So what transactions you're doing, um, uh, how much money will be paid to you every month, if that is controlled by the employer, then again, that would be defined as a common law employee. And then if you have an employment relationship, the employee-employee relationship as defined in the contract, as defined by a contract, legal contract, then you would be defined as a common law employee. So again, just for an example, if you're an office manager working under the supervision of a business owner, that is clearly defined as a common law employee. You would be subject to Social Security, you would be subject to Medicare taxes, and also federal income tax. So all of the three taxes would be applicable to you. The last one is about independent contractor. Now, independent contractors are basically who are self-employed and they pay self-employment tax. They do offer services to the public, and the client or the person who employs the independent contractor only controls the result of the work, right? So say suppose um, production company hired a writer to write a script for the film. Now, the production company just, instructs or provides what the end result is required from the writer, right? They do not control his timings. They do not have a full employment relationship with the writer. So in that cases, we would term it as an independent contractor. A specific or a very good example would be any freelancer who's working in a certain specific industry would be termed as an independent contractor. The other thing to consider is when you employ a spouse or a parent of a certain employee. Say if you're working in an organization and if you refer your spouse or your mom and dad in the same company, they're also be treated to or subject to federal income and FICA taxes, but they're not subject to federal unemployment tax. So that is one major consideration from a US tax standpoint. Similarly, if you're working in an organization and you refer your kid to be hired in the same organization, now there are different rules when the kid is hired, when your kid is hired in the organization, they would not be subject to FICA if they're under 18. They would not be subject to FUTA if they're under 21, but they would still be subject to federal income tax regardless of their age, right? Now, FICA, FUTA, all of these are very different terminologies. We'll be covering that in the next slide, but I just want you to be aware that, if a child is employed by the parents, it's not subject to FICA if it is under 18, and they're not subject to FUTA if they're under 21. Again, the business must be sole proprietor or a partnership where both the partners are as parents. Trust fund recovery penalty, this concept basically states that in cases where you're required um, to withhold certain taxes, and if you don't do it, then the responsible party, that is you, would be subject to full amount of the unpaid trust fund, the tax that is owed, plus any interest that is incurred because you haven't remitted the payment on time, right? So if our company who hires us as employees, if they don't really withhold taxes every year as TDS or every month as TDS, the government obviously is not going to keep quiet, right? They're going to levy penalty, which is going to be interest, or depending on which state authority is issuing it, it will be interest plus the tax that is owed to the government. The other thing is about electronic federal tax payment system, also called as EFTPS. It's basically an electronical way of paying taxes or remitting tax to the authority. There's obviously a requirement of when it has to be done. Obviously, it can be optional as well. Even if you owe $1 of tax, you can use EFTPS to pay it. But if you exceed a certain threshold, it is required and it is mandated. If you do not pay it electronically, there's a 10% penalty that is imposed by the government. Obviously, they want to promote more of electronic transactions. They do not want, more of check payments, more of cash payments. So there's a penalty that's levied, and that's about 10%. Now, if that tax liability is 50,000 or less, then you do have to make monthly deposits to the IRS. If the tax liability exceeds 50,000, there's a semi-weekly deposit. That is, you would have to pay twice a week. So we were talking about FUTA and FICA in the previous slide. Now this FUTA stands for Federal Unemployment Tax Act, and FICA stands for Federal Insurance Contribution Act. So FUTA is basically, IRS withholding certain tax to cover up for unemployment that is generated in the economy or in the country. So when you reach a certain age, and if you are unemployed for a certain period, IRS would be giving you certain funds every month. So that's why they want to cover up this with a tax that is withheld from each employee as part of their employment. Now employer must pay FUTA if 1,500 or more wages is paid in any quarter. This is combined. This is not at the individual level. So if you as an employer are paying wages more than 1,500 or equivalent to 1,500, then you are required to pay FUTA as well. Or if you employ one or more employees for 20 or more weeks, then you are also required to pay FUTA. The form that you would file to pay FUTA is Form 940. Just as an information, you'll have to remember this for the exam purposes. And the state equivalent is equal to state unemployment tax, which is also called SUTA. Federal Insurance Contribution Act, or FICA, is combined of two things. One is your Social Security tax, the other is your Medicare tax. Social Security is levied at 6.2% of the employee's wages. Medicare tax is levied at 1.45% of the wages, which in total would be 7.65% of the total tax that is withheld as part of FICA. Now, for a single individual that is filing, if you're filing as a single individual, then if your wages are above 200,000, then you would also have to pay additional Medicare tax that is levied at 0.9%. If you're filing as a married filing jointly or as married filing separately, obviously the threshold is different. It is 250,000 and 125,000 respectively. All of this is tested in the part 1 of the EA exam as well. So not throwing more light on that, but you just have to remember that, there are different withholding requirements in terms of FUTA and FICA. And FUTA is paid on Form 940 and FICA is paid at 7.65% tax rate. There's another tax and withholding requirement, which is also called Self-Employed Contribution Act, or SECA. Now, this applies to self-employed individuals. There's a 10% penalty if you don't remit the payment. Again, there's monthly deposit, semi-weekly deposit based on if you exceed the 50,000 threshold or if you're below it. All right, so moving on to the next session. Now, certain returns are just informational and filed with the IRS to provide them the right information so that they can go back and make sure they're able to reconcile based on what the entity is filing, what's reported, what transactions are happening within the organization, and they're able to reconcile all of this on the back end. So they don't really pay tax on these informational returns. This is just providing the required information to the right tax authority. So again, from an informational return topic standpoint, I would say that you might see some of these forms pop up in the exam, and they might just ask you for due dates. They might ask you, what form relates to which section. So you just have to remember this. We'll talk about it very quickly. So most of these forms, one thing that you would notice is the due date is on the February 28th of the tax year. So February 28th is when you would have to file this with the IRS or the Internal Revenue Service. But the due date to the recipient, right, on whose behalf you're paying these taxes, the actual recipient, you'll have to issue them the form by January 31st, which is 1 month before when you file the IRS. Because obviously, the recipient will have to file their own tax returns. So they need that additional 1 month to make sure they comply with the requirements. From an experience standpoint, I would say that, popular forms that we see on the exams are 1098, the mortgage interest statement, for any interest generated as part of your mortgage that is given. 1098 E and T, which is your student loan interest statement or your tuition statement. And then we also see 1099 C, which is your cancellation of debt. Some of these forms have been highlighted in terms of due dates with an asterisk. Now that basically means that there's an additional month time if you file these forms electronically, right? So the due date would change from February 28th to March 31st. So that is something to keep in mind when you get any question related to electronic filing of these forms. Again, some more forms that are listed. I would say that, when you wrap up this class, just go back and go through each of these forms, what title it stands for, the different due dates. Again, except for 1 or 2 forms that are an outlier, I would say all of these forms are required to be filed with the IRS on February 28th, and the due date still remains same for each of these, that is January 31st. I would say that on this slide deck, one of the important form to remember, or some of the important forms to remember, are 1099 DIV, dividends and distributions. So this would be obviously issued by a corporation for any dividends that is distributed to you as part of their income that is generated. 1099 INT, interest income, that is another popular form that we see on the exam. And obviously you have some other that relates to 1099K, 1099 MISC, which is more from a transaction standpoint. If you make any third-party transaction, if you make any card transactions, so all of those are listed on 1099K and 1099 MISC. If you remember, we spoke about statutory non-employee. So if you are a statutory non-employee and if you're remitted payments, that is again reported on 1099 NEC, which is your non-employee compensation. So again, the due date for 1099 NEC differs from the rest of the forms. It is January 31st for both the IRS and the recipient. So that is something that is an outlier amongst all of these forms that we spoke about. W2G is another popular, and W2 is obviously the most popular one that we see on the exam. W2G is for your gambling winnings. That is, if you've generated income as part of gambling using any casinos, any online gambling games, then that income that is reported on W2G has to be filed with the IRS by February 28th, and the due date to the recipient is January 31st. Now, obviously, who should be filing these would depend on whether it's a casino, whether it's an online gaming agency. Obviously, the requirement to file or the responsibility to file lies on them. W2 is more like a Form 16 that we receive in India. So this is a wage and tax statement where all your salaries, all your commissions, bonuses that is generated is reported by your employer, and your employer files this W2 with the IRS. Sorry, not the IRS, but the Social Security Agency by January 31st of every year. And they also issue you this W2 if you're employed in the US by January 31st, so that you can have enough time to report all of the salary or the income that you generated with the employment and file your own tax return as your requirement. All right. Moving on in terms of accounting periods and methods. Now, there can be different accounting periods that can be used by a business entity. Now, this differs based on what election they've made, what is the entity type, different methods are provided. So key things to remember when we are talking about accounting periods, the most popular one is the calendar year that we see, which is January 1st to December 31st. Now, most of the partnerships, most of the corporations are set up during this period. They file tax returns based on the calendar year, which is different from what we see in India, right? We have our tax year, which is different from a calendar year, which is April 1st to March 31st. In the US, it's mostly a calendar year. Any year that is any 52-week or 53-week period, which is different than your calendar year, is called a fiscal year. So you would also see some entities opting for a fiscal year. Now, partnerships and S corps can adopt fiscal year, and they have to make specific election to do that. Partnerships have to file Form 1128 to file during a fiscal year or to use a fiscal year, and S corps have to use 2553 with the IRS to elect using a fiscal year. Corporations, on the contrary, they do not really have to file any other specific form. They can just use the fiscal year on their income tax return, the first filing on 11/20, and start filing with the IRS using the same fiscal year, so that IRS can be updated on one tax year or what fiscal year is used by the corporation. Can everyone mute your mics, please? Darshan, I think you're unmuted.
Gaurav, can you just let us know Form A, what is Form 8716?
Yeah, so there's a small business election. If you are making a Section 744, 444 election, then Form 8716 has to be filed. I didn't really want to dwell deep into this because we'll again be covering this when we talk about partnerships and corporations. But just to remember that if you're making a Section 444 election, then Form 8716 also has to be filed for a fiscal year.
Okay, fine.
Yeah. All right. Moving on, we are talking about certain concepts in terms of accounting methods. So there's a concept called as all events test or an accrual test, which is basically talking about the accrual method of accounting, right? From a tax return standpoint, what the IRS has provided guidance is that when you record income, there has to be certain criterias that are met. Obviously, you can record income when the required performance has taken place, when the payment is actually due, and when the payment is received. So when all of these three criterias are met, only then you are supposed to record income from an accrual standpoint based on what the guidance has been issued by the IRS. Now, when we talk about expenses under accrual method, it says that only deduct expenses when the amount of liability can be figured with reasonable accuracy and the economic performance has taken place. If both these criteria are met, only then you can deduct those expenses under accrual method on your tax return. So these are certain criteria you'll have to remember. We'll also, when we look at certain questions in tomorrow's refresher session, we'll actually look at specific practical examples on how this can be applied. But just to remember that there are different criteria to record income and deduct expenses on your tax return under accrual method. What does the gross receipts test say? Basically, if your average annual gross receipts for the last 3 taxable period doesn't exceed 29 million for tax year 23, then the gross receipts test is met. And this gives you a benefit as a small business taxpayer, right? So if you are a small business taxpayer and you meet the gross receipts test, then you can use cash method of accounting. You don't really have to, worry about if accrual method applies to me, if all of these different criterias are met. So you can directly use cash method, which is basically when you shell out the money or when you receive the income, you just record it. And it also exempts you from the requirement to capitalize inventory, certain capital expenditures that you make on say machinery, equipments, and all of that. So the gross receipts test is something that can also be tested on the exam in terms of what the threshold amount is for tax year 23, which is 29 billion, and what the benefit is for a small business taxpayer.
Sorry for the
Hey Praveen, I think you had a question.
Hello.
Yes, Praveen, go ahead. All right, I think there was some disturbance, but
Hello.
we'll.
Hello, Gaurav. Can you please go back to the previous slide just? So, you mentioned the fiscal year. So the fiscal year still follow the same due dates as like the regular calendar year or any separate due dates?
No, the due date remains different. Obviously, it's based on the end of your tax year.
Yes.
It is different from a calendar year. So it can depend on which entity is filing the tax return. For a partnership, it's different. From a corporation, it's different. So again, yeah, the due dates differ for a fiscal year versus a calendar year.
Yeah, so for each revenue generation, we need to file a different form, right? So accordingly, we need to, I mean, like adopt the due date based upon the fiscal year, right? That's the context, right?
I don't think I understood your question correctly. Could you repeat that?
So, I mean, for every revenue generation, for different revenue generation, we are filing the different form, right? So
No,
similarly,
it's not based on your revenue generation. It is based on the election that you make. If you have elected to file tax return based on a fiscal year, then your due date remains, based on the end of your fiscal year. If you're filing based on a calendar year, then it remains different. That's one concept that you'll have to remember.
oh, thank you.
It is not based on revenue generation. And again, I would request everyone to park your questions at the end so that we could cover all the concepts and then go back to questions. It really interrupts the flow of the session and does not benefit the entire class. So please park your questions in the chat box or at the end of the session. All right. So in terms of 12-month rule, basically it says, a certain prepaid expenses have to be recorded that do not extend beyond the 12 months after the benefit begins, or after the right or benefit begins. So there are certain prepaid expenses that has to be recorded only after the right or benefit has been incurred, and there's a 12-month cool off period before you can actually record it.
What is
Construct
right of benefit means? Could you
Prabhakar,
please?
could you please park your question at the end? I think we can definitely address it.
Yes,
But I would request at the end of the session, it would be beneficial for everyone.
because if you don't understand, how can next step will you will understand? So that is the reason I'm asking.
No,
Like,
definitely, I agree. If certain concepts are not clear to you, I would suggest that you park your question at the end and we can revisit it. But then if you're interrupting the flow, I think it might not benefit the entire class. So we can definitely go back to any of your open questions, queries at the end of the session. All right, talking about constructive receipt. Now, it basically means that you can record receipt of income only when the amount is credited to your account, or if it is made available to the taxpayer without any restrictions. Say, suppose there was a condition levied on the income that only if you meet certain conditions, then the payment will be made to you. Then in that case, constructive receipt is not met and you cannot record that in your tax return. And again, in terms of constructive receipt, possession is not a requirement, right? You don't really have to have the money in your bank account. It basically is, if the check is issued, then you do have your constructive receipt. Possession is not a requirement in terms of constructive receipt. Cash and accrual method, we spoke about it. Cash method is where you record your receipts and um, record your expenses and income when the cash is, shelled out, or when you receive cash within your firm, you record it as and when you do that. Accrual method is when the revenue is met or the income is met based on these conditions that we spoke about, whether the performance is met, when the payment is actually received, and the amount can be determined with reasonable accuracy, and you deduct expenses when it is actually incurred and not when it is shelled out. Percentage of completion method applies for long-term contracts. This is usually in terms of construction companies that we see, because when a construction company takes up a project to build, say an apartment, it does not really happen within the same taxable year, right? So in that cases, the IRS has defined certain guidance that based on the percentage of completion of the total contract, you'll have to recognize revenue in a certain year. Say if you built 30% of the entire contract, then 30% of the revenue and expenses have to be recorded in the same tax year. So this specifically applies to long-term contracts, and we mostly see this in the real estate market. Fiscal year, like we spoke about, is any 12 consecutive months which ends on the last day except December 31st. Now, this could be, the tax year that we follow in India. It could be April 1st to March 31st. That could be called as a fiscal year for US tax purposes. It could also be from July 1st to June 30th, where most of the accounting firms, all of the big fours follow this fiscal year. The tax year would be July 1st to June 30th. So any 12 consecutive months that does not end on December 31st, or basically not a calendar year, is a fiscal year. Now, trusts cannot use fiscal year. So just a reminder there that, all the other entity types, say partnership, corporation, S Corp, can use a fiscal year, but a trust cannot use a fiscal year. Few more things that I wanted to cover, but you could start dropping in your questions so that, we can address it.
In the tables of this, for the slides you have shown in that tables, you have mentioned two due dates. One was for the IRS and the other one was for the recipient. Yeah. So could you please explain the difference between these two?
Yeah. So from an employer standpoint, there are two different requirements. One is when this form should be filed with the IRS, which is your tax authority, and the other is when it is actually, given to the recipient. So say if you were an employee with the organization, right, and you were receiving a W-2, right, which would show your salary, your bonus for the year, then the W-2 has to be filed by your employer to the authority by January 31st, which is one due date. It also has to be filed to you so that you can get that information and report it on your tax return with the required due date that's provided here. So again, there are two due dates. One, because there are two different participants here. One is the IRS, which is the tax authority, and the other one, it's your recipient, right? The end person who will be utilizing this information to file the actual tax return. Does that answer your question?
Yes, thank you.
No problem. Here in February 28th with asterisk mark, that means if this form has been filed with IRS on paper filing, and if it is electronic filing, then the due date would be March 31st, right?
Yes, that's accurate. Right. Okay. So again, IRS is giving you the benefit to file electronically. You have one additional month. So we have seen a lot of firms switching to electronic filing or e-filing as we call it. So you have one additional month there to, file these forms.
Fine.
Gaurav?
Yeah, go ahead.
But the actual due date of 1040 is April 15th, right? Then
yes.
Explain
so again,
like March 31st.
Yeah, these are informational forms that we are talking about, right? These are not 1040 individual return that we are talking about. So say, suppose you were a salaried employed or an individual, right? So all of these forms would be received by your employer. Say you would be receiving W-2. You might have gambling winnings from some certain casino that you played in. You might receive W-2G. So all of this information will be received to you by January 31st so that you have enough time to collate all the information and prepare all the work papers to file the tax return by April 15th, like you mentioned, for individual tax return. That's why the due dates given to the recipient is much earlier than the actual tax return due date, because these are just informational returns. The tax is paid on your individual return. So you will be receiving all of this information from different participants, whether it is your employer, whether it is your casino, whether it is your bank. And when you collate all of this information, then you can actually file your tax return.
Yeah, what about Feb 28th?
Feb 28th?
Like I'm confused with the April 15 and Feb 28.
Again, April 15th is the due date to file your individual income tax return, which is Form 1040, right? That is different from these informational returns that are there. These informational returns have to be filed by different entities. These are not the individual returns that we are filing. We are talking about business entities that have withholding requirements and reporting requirements. based on what category they fall under. Now, if you had taken a student loan, say from a bank, then the bank would have to file a 1098E to report the student loan interest that it generates by February 28th to the IRS, and it will also issue a 1098E saying that this is your interest amount that you have paid on your student loan, and this will be issued to you by January 31st. So then what you could do is you could utilize this information and file your individual return by April 15. So you have additional time to file your return. Now, again, don't confuse it between individual taxation and business taxation.
Got it.
Yeah.
Could
So
you please explain
Gaurav,
more?
here, like, for instance, the entities are following the fiscal year. So I'm filing my income tax, I mean, my return, personal return. So by the time if the, the entity not unable to report because of the fiscal year, so still do you want an individual to file, file the return? Like, for instance, the betting revenue, which is already generated, but the entity was not filed because of the fiscal year due date. So still the individual need to report that?
Yes, they have to, because again, if you think about it, these transactions can happen throughout the year, right? You might
Yeah.
not know when your gambling winnings are happening, when you receive interest and all of that. So this can be throughout the year, but the due dates are fixed irrespective of whether you are a calendar year filer or a fiscal year filer, because the ultimate individual investor, right? You as an individual have a due date to file tax return by April 15th of every year, right? That will not change. You cannot opt for a different tax year. So the IRS has set specific dates irrespective of whether it is a fiscal year filer or a calendar year filer.
Still I see some gap. For instance, one entity following fiscal year from June to July, for
Right.
instance. So I'm filing income tax return for the calendar year. So for that particular year, I'm able to file the income tax return for January to December. So if I go and play, revenue generated in the next coming year, for the fiscal year, so the entity may not report that revenue, right? So the entity may not provide information to the federal department, right?
No, they will have to do it annually every year, right?
Okay.
Whether you follow July to June or January to December, you would have to go through this annually every year, right? So it might happen that there is a lag between when they report based on if it is a fiscal year or a calendar year, but it will definitely be reported at some point.
Got it.
Yeah.
Sir, could you please go back to the classification of employees, that tab, that slide?
Classification of what?
The employees, the different type of employees mentioned in that slide. Yeah. Here, as you were explaining the statutory, non-employee, statutory employees, and independent contractor, the characteristics and behaviors are nearly equally same. So, can we consider that employee is type of employee classification is of two types? Like the one is common law employees, and another one is like the independent contractor.
No, the definition differs because the withholding requirements for each of these, right? When we talk about statutory non-employee, when we talk about statutory employee, or when we talk about independent contractor, the withholding requirement for each of these will differ. Now, if you are falling under the category of independent contractor, then you're only subject to self-employment taxes. But if you are a statutory employee, then your employer has to withhold Social Security and Medicare taxes from your income before it remits you the payment. It does not has any federal income tax requirement, but it will have to withhold Social Security and Medicare taxes. Where in case of statutory non-employee, that is not the case.
But for the in that case, is for statutory employees, uh, he or she should be on the payroll of that company. Is it?
For
Or yeah, just they have a contract. Likewise, I mean.
No, they could be a full-time agent or a contractor, right? So think about it from a life insurance perspective, because that's more relatable. Say if you were a life insurance agent for LIC, you might not be receiving, salary or fixed salary every month, but you know that you're working full time for LIC by um, promoting LIC policies, issuing LIC policies, and you will receive commission based on that. So technically, from a statute perspective, from a legal perspective, you can be termed as a statutory employee, but you don't really have a legal contract binding you with LIC, right? You don't have a legal contract that terms you as an employee of the LIC. You're just a full-time agent working for LIC.
Okay.
Explain about the terms which you told, like subject and non-subject to the social security and medical benefits.
Yeah. So each employer in the US has certain withholding requirements. Withholding basically means that they reserve certain portion of income or the salary or commission that you generate before they pay you. It is similar to TDS, right? If you're working for any organization, before salary is paid out, they withheld TDS on your income, right? Which can obviously be claimed later on in your tax return. So similarly, in the US, the IRS has said that based on the employee definition, whether it is a common employee, whether it's an independent contractor, there are different taxes that has to be withheld. Now, these taxes are usually used for the benefit of the economy or the public in the future. It can be for unemployment purposes, right? Not everyone is employed in the US. So they might be giving, say, $1,500 to all unemployed employees. They might be using it for Medicare purposes. You might have heard that medical facilities in the US are, almost free for a lot of people. They might be using it in education, right? So they might be investing back in the economy. So they are saying that each of the employees or each of the different categories of employees have to pay certain taxes, and the employer has the liability or the responsibility to withhold these taxes. Now these are classified into social security and Medicare taxes, which is your FICA that we spoke about. Your social security tax is at 6.2% and your Medicare tax is at 1.45%. That is your FICA. There is also called as unemployment tax, FUTA. Now this can again vary based on what slab you fall under, but again the different requirements are that unemployment tax has to be withheld from your income, social security has to be withheld from your income, Medicare tax has to be withheld from your income. Along with that, if you are a high salaried employed or you're generating income more than say 200,000, if you're filing single, then additional 0.9% has to be withheld from your salary or commission.
For this FICA, do we have form just like the way we have for FUTA?
Yeah, it is with the SSA. So let me just pull up that one.
Okay.
Yeah. It should definitely be there. Let me just pull that up. Any other questions while we go back to FICA?
Yes,
Actually,
I do have one last question to the on the second slide of tax withholding and reporting regarding the child employment by parents. So, can you please go back to that slide, or let's just move with the question?
Give me 1 second. So Anil, to go back to your question, FICA is just reported on your 1040. So they don't really have a certain specific form, and it is paid on the Social Security Administration website, SSA.
Okay.
All right. So if I go back to the previous slide.
No, the tax withholding reporting slide only, sir. Child employment by parents. The next. The next, yeah. So this one, so while you explaining that the subject to federal employment tax and regardless of age and business must be so, I mean, the FICA is under 18 and FICA is under, FUTA is under 21. So regardless of this employment, the child labor law is applicable here, right? for the employees like under 18, they could not, they will not allow to work on the hazardous workplace, and under 15, whatever the child labor law is there in the US, that is applicable here, right?
Yeah, I think I'm not really very sure about the legal requirement. What applies for a person under the age of 18 and what is allowed or not allowed in the US. But from a tax standpoint, say, they might be allowed, or they might be allowed certain activities. They could be doing a part-time job for their parents, and if they were involved in that business, then they're not subject to FICA if they were under 18, and they're not subject to FUTA. But from a legal standpoint, I'm not really sure if whether it's allowed or not allowed in the US. I think something to go back and research more about, but I'm not really sure what the child labor laws are in the US.
Gaurav, can you just explain on to the, we had something like economic event should take place.
Which one? You're talking about
Yeah.
all events test?
Yeah.
Okay.
Economic performance takes place now at the in with respect to the expense. I mean,
Yeah, the economic performance basically, say suppose,
of services we should have performed or something like that, or
yeah,
we
say
must have.
suppose if you had a business and you were setting up a new office, right? And you might
Mhm.
have given contract to an interior designer to complete all of the interiors within your office, including your furniture and everything. Now,
Mhm.
the although you have contracted that person or the interior designer to complete the project, the economic performance hasn't really taken place until it is completed, and that can take couple of months, couple of weeks, depending on how big or small the project is, right? So only when it is the end of the project and the complete activity is completed and you pay out that entire amount for the transaction or the contract, only then the economic performance has taken place and you can record that expense as part of your business. So that is what the economic performance states, that the IRS will not allow you to recognize expense in January if the completion was in March, right? And if it is for a very long term, which is beyond the tax year, right? If January 1st to December 31st was your tax year, if it is beyond that, then percentage of completion method comes into picture for long-term contracts.
Right.
Yeah.
Got it. Thank you.
No problem.
Hi, Gaurav. A quick question. This is with respect to the entity types that you were discussing. So when you said S corps are more of a hybrid, that it holds characteristics of a partnership as well as C corp. I don't know if I missed it, but can you tell me what features of a C corp does an S corp hold?
Yeah, sure. Let me just go back to this slide. Yeah, so when I was talking about S corp, again, just to refresh, there's a 100 shareholder limit. And I was talking about the hybrid nature of an S corp, right? So it has limited liability protection. In cases of partnership, depending on what type of partnership you have formed, it can depend if it has a general liability or a limited liability, right? It can be unlimited or limited. But in cases of S corp, it is limited liability protection, just like a C corp, right? The shareholders are not personally responsible for any losses that is incurred. Only their contribution or only the amount that is initially raised or contributed during the year is subject to any event that might happen. So that is one thing. The limited liability protection is very similar to C corp. The other feature which is comparable to partnership is the pass-through taxation, right? So S corps do not pay tax at the entity level. They pass on the income to their shareholders, and the shareholders ultimately file their tax return and pay the tax depending on whatever entity type it is, right? Mostly individuals in our case. So that is comparable to a partnership, that it has pass-through taxation. Now, one unique thing about S corp is that it has a limit, which is not, in partnership or a C corp. Now, this is only applicable to S corp, that it has a 100 shareholder limit. Again, S corps also raise money through public now or shareholders per se. Now, this is in a private exchange. They can't be listed on a stock exchange for that matter because they're not a public corporation, right? So they can be raising capital using stocks, but it can be only one class of stock, unlike to a C corp. So it has some bit of feature that it can raise capital through stocks, but not more than one class of stock. Again, similar to a C corp, it also has corporate formalities like holding regular board of director meetings, shareholder meetings, which is not the case in partnership, right? They don't really have board of director meetings or shareholder meetings, and maintaining bylaws like how a corporation would do. So all of this is very common to a S corp and C corp. And again, like I said, an S corp has to file an election with the IRS, which is 2.5 months from the beginning of tax year. They have to file form 2553 to make this election. Only then a corporation would be treated as S corp, because by default it is a C corporation. Only if it files an election, then it would be treated as an S corp. And again, similar to C corp, they also distribute wages. They do dividend distributions to its private shareholders. So that's again a similarity between an S corp and a C corp. Does that answer your question?
Oh, yes, very well. Thank you so much.
No problem.
Gaurav, just one thing, actually, for the qualified joint ventures, can it also take the form of something like partnership, S corp or C corp, or any of which form they go for filing their tax return? 1040
Yes.
or like?
Yeah, qualified joint ventures is a partnership. It is definitely not a C corp or an S corp, but
Okay.
for tax purposes, what they do is they would still be filing 1040, right? So qualified joint ventures is applicable only for couples who are married filing jointly. Say you and your wife were married filing jointly and had a business that both of you were actively involved in, right? Then you can form a qualified joint venture and claim business expenses on Schedule C of your Form 1040. So that is one benefit that you get, that you can claim business expenses. The only the requirement would be that you both should be actively involved in the business, and you would still be filing individual returns. You would not be filing a partnership tax return. You would still be filing individual returns, but using Schedule C of the Form 1040.
What will be their tax filing? I mean,
The tax liability?
no. I mean tax filing classification, I would say. Just like
It would
LLP, LLC, no, we do have option.
No, they would. So again, qualified joint venture from a tax purpose do not have a separate filing requirement, right? They would still be filing individual returns, but it is only applicable to married filing jointly couple.
Got it. So basically, okay, got it now. So they will be just putting all the expenses onto their individual returns under Schedule C.
Yes, yes. So previously, what used to happen, right? Before this qualified joint venture came into picture, if a couple was doing business, then they would be treated as partners in a partnership form, right? They would be treated as partners and required to file Form 1065. So that was one additional obligation for the couple who was doing business together. So that the IRS thought about that, ultimately these are one family doing business and they can be paying taxes just on their Form 1040. They don't really have to file a separate Form 1065, although they are in the form of a partnership. Legally, they might be a partnership, but they don't really have to file a 1065. So that's why they came up with qualified joint venture. And they said that if you have a partnership and both of the partners are married to each other, then you just have to use Form 1040 Schedule C to file your tax return. You don't really have to file Form 1065 separately.
Okay, so for in that case, herein there must be at least one LPA, na? Just like we have in the partnerships.
Yes, yes.
There has to for the legal purpose.
Correct. Yeah. Yes, that's true.
Okay.
And again, a lot of community rules come into picture. Some of the communities in the US define that the income and losses have to be shared equally, 50% equally, between the husband and a wife. Some are very open based on whatever the contract might say, your partnership agreement might say. But for IRS purposes, it also depends on which community you set up your qualified joint venture in.
Right. So they will be filing only one 1065, wherein they will jointly, uh, claim the business expenses into the books.
Yeah, not the 1065. They will only be filing
Sorry,
1040.
1040. 1040. Yeah.
Yes, correct.
Okay. Thank you.
No problem.
Sir, in the tax withholding slide, in the FUTA point, there was something around like $1,500 amount, must pay $1,500. So can you explain that point?
Yeah, this is as simple as if you were an employer, right? And if you were paying $1,500 in wages to your employees in one quarter, then you are subject to FUTA. If that wages amount was less than 1,500, right? Small businesses might not be paying out so much amount to their employees, then you're not required to do FUTA taxes. It's similar to the PF requirement, the PF requirement, EPF, Employee Provident Fund requirement. I don't recall exactly, but I think only if you have 10 or 20 employees within your firm, then you're required to do EPF, right?
Kind of professional tax?
It's not professional tax. FUTA is basically used for unemployment purposes. So when there's an economic downturn, say in COVID, a lot of people lost jobs, right? They might be employed, but they lost jobs in COVID. Then the government uses this FUTA contribution of funds to give certain minimum amount to these unemployed individuals, and this is recovered from everyone who is employed in the US.
Got it.
Yeah.
Thank you.
No problem. I think we just have we are overboard, but I would take up 2 or 3 questions more, and we should be able to wrap up, just because it's almost beyond the time that we were scheduled for. But yeah, we can take up few questions very quickly.
Yeah, I had two questions. First of all, you mentioned something called backup withholding. Will that be covered in the following sessions?
Not really. So backup withholding was certain concept that I didn't really want to focus on, but I can cover quickly if you want me to. But yeah, it will not be covered in the future class. So backup withholding, just to give you a quick example, is additional withholding that might be required. I think it's at the rate of 24%. It is subject on Form 1099. That is, if an employer does not has TIN, right? Certain people might not be reporting their TIN, taxpayer identification number, right? How we have PAN. Then backup withholding comes into picture, and they'll have to withheld, a share of tax at flat rate of 24%. Again, this is not a very popular concept that is tested on the exam, so I didn't really want to dwell deep into it.
Okay, that answers my question. Thank you. And my second question would be, do we need to also read from the IRS website, or the notes that are sufficient? Like, just wanted a brief idea what
No,
would
I would
you as
suggest
in
2 things. These PPT decks can be used as revision once you've gone through the textbook that's provided by Fast Forward Academy. You don't really have to go to IRC Internal Revenue Code to read through code sections. The book provided by Fast Forward Academy should be sufficient, and these PPTs can be used as a refresher when you are doing a revision.
Okay, thank you so much, Gaurav.
No problem.
Do we have any Telegram group for sharing the details of like class or other things?
Yeah, there are 2 Telegram groups for enrolled agent. One is for the class sessions that happen, and the other one is to raise any Q&As that can be answered by your fellow students or by myself. So you can definitely ask Madhuri or anyone from Simandhar Education to add you to that group.
Thank you.
Excuse me, sir.
Yes, go ahead.
So the FUTA tax and the FICA tax is for the journal economy. I mean, is it deposited to the particular employee's portal or is it for the general economy?
No, so FUTA is used for the whole of the public in the US, right? It's not really something that you will get back like how we have PF, that gets deposited every month, and at some point of time when we retire, we will get back PF. So FUTA is not used in that way. FICA, on the other hand, there is a certain contribution that gets deposited in a FICA contribution on the SSA, Social Security Administration website. And then if you encounter issues in terms of your retirement or in terms of your medical facilities that have to be claimed, then these contributions that are withheld will be utilized in that cases.
Okay. Right, sir. Thank you.
No problem.
Hello, sir. Can you explain common law employee?
Common law employee, again, very simple if you think of it as a regular employee that is employed with the firm, right? Say you were working with one of the big fours. It is as simple as you are treated as a common law employee for US tax perspective. That is, you have an employment agreement with one of the big fours. You're working for them full time. All of your work is monitored, controlled, and scheduled by that accounting firm, right? So you can't really be your own independent owner. You can't really have control over your schedule. All of that is controlled by the employer. So it's just a regular employer-employee relationship that is in picture.
Thank you.
Okay, I'll take one last question before we wrap up, just in the interest of time. But if there are any other questions, maybe you can put it in the Telegram group and I'll do my best to answer it. Yeah, go ahead.
Yeah, hi, Guru. With regard to the informational forms, can you just go to the slide, on the exam perspective, do we need to remember all these, amounts, dates, and all, from your past experience, how relevant, or if you can.
Yeah, I would say from my past experience, what I've actually seen is mostly what each of these forms relate to, whether it relates to student loan interest, whether it's about, a mortgage interest, whether it is gambling statement, whether it's a regular wage statement. That is something that can be asked. The other thing is about the due dates. That's more likely that you can see on the exam. It is very unlikely that they would ask you specific amounts that is reported on each of these because it's too detailed to go into. So mostly it would be, what each of these forms relate to and the due dates.
All right. Thank you.
And again, if you think about it, if you look at all the three slides, the due dates are pretty consistent except for two outliers that we highlighted. So you can think about it as mostly February 28th for all of the informational returns. And 1 month before that, it is issued to the recipient. That is January 31st.
Yeah. Thank you.
All right, guys, I think it was a pretty active class. I know you guys would have more follow-up questions. I would encourage you to put it in the Telegram group. If you do not have access to it, you can ask Madhuri and she can add you to the group. I will do my best to answer those questions. And of course, if there are any other experienced fellow students, do definitely participate in responding to the questions. That way, you can increase your knowledge as well. And then in tomorrow's session, just before we start, I'm going to go into Fast Forward Academy portal, pick up a few multiple choice questions so that, as a group, we can solve some of these live. And it would serve as a refresher before we talk about the next topic.
Yeah, thank you, Gaurav, for that thing. And from tomorrow, like proceeding further for the every weekends, the class will be in the morning from 11 a.m.
Yes, it will be consistent. Consistently in the morning, 11 to 1 is mostly what we would be going on.
Thank you.
All right. Thank you so much, everyone. Have a good rest of the
It was
evening.
a wonderful session. Thank you for answering all the questions, Gaurav.
Yes, too informative, Gaurav. Thank you so much.
Thank you, guys. Bye-bye.
Bye.
Thank you.